To have Tim Jennison come to give us a talk today on navigating financial markets in volatile times. Tim is a SAIS alumni class of 1991, so he's a youngster, having spent 2 years in DC, and he's actually done extremely well for someone that didn't do at least 1 year in Bologna. So congratulations on that, Tim. He was born in the UK and grew up in Switzerland. Post SAIS, he worked in finance until joining Morgan Stanley in London in 1998, where he became managing director in 2008, just in time for the crisis. He's been part of various regional and global leadership positions at Morgan Stanley, always in the area of sales and trading. With that focus, he's been head of fixed income Germany and Austria, head of EMEA credit sales and trading, head of global bank relationships and solutions business, and a member of the EMEA fixed income operating committee and global credit operating committee. He joined the Boston Consulting Group in 2016 and built and led the global capital markets and investment banking segment of BCG. He advised global and regional bank membership teams on global markets and investment banking, strategic positioning and efficiency, organizational optimization, and those sorts of things. He retired from BCG at the end of 2024, so hasn't even been out for a year yet. He's founded a small family office and manages families' financial assets and is senior advisor to BCG still. And of course, he is a member of our SAIS board of advisors in DC since 2014. So welcome, Tim, and we're really looking forward to your remarks. When I convinced Tim to give a talk here, and he accepted, but he really wanted me to give a kind of an overview of what's going on and so the macro context before he plunged into the micro context. And what's going on in there? I mean, there do seem to be some positive things out there, it would seem. Stock markets have been strong, even some would say frothy. Labor markets in the United States and in parts of Europe, including this country, aren't bad. It's not clear where some of them are going. China has challenges in the labor markets, but in general, we're certainly not in a economic downturn at the moment. Okay, it would seem. GDP forecasts are still positive. Some of you saw the IMF's World Economic Outlook, which came out in October. Yes, global growth was revised downward slightly to 3.2%, but that's still not bad. The US is expected to grow at 2%, Europe at, I believe, 1.6%, and emerging markets and developing economies at 4.2%. These are not spectacular growth rates, but they're also not crisis. But still, one sees a bit of nervousness when you read these when you read the IMF and the World Bank and other institutions about what the future looks like. After all, inflation is still above target, particularly in the United States. In fiscal policy has been a major problem in developed countries and continues to be so in the United States. Many of you know that the Biden administration left the Trump administration with a deficit to GDP ratio of about 6.4%. Which is absolutely huge in peacetime. And so at the end of the last fiscal year in September, the US debt had increased to $1.8 trillion. The big, beautiful bill that was passed is being estimated to actually increase that. And there doesn't seem to be, I think and Tim could say this later, the markets don't seem to be having any effect on the US. This is a problem. Even right now, they're talking about giving back $2,000 checks to Americans because of tariffs. And that brings us to the uncertainty of the tariff policies that have been, obviously a controversial thing since the new administration came in, and have had announcements about what's going on in tariffs. Has had major effects on the stock market, both positive and negative. So it's been quite a roller coaster ride. And so I guess the something else that's been a question has to do with, in the United States about monetary. By the way, the fiscal issue isn't just in the United States. I mean, look what's going on in France, where you have governments falling and you don't seem to have a strong, real political constituency to sort of figure out the deficit problem. And it's a priority in France, but it's not clear where it's going. In the United States, it doesn't seem where it's going, and it doesn't seem to be a priority. So those are big issues. Anyway, this is the happy context in which I'll hand over to Tim what this might mean for financial markets.
Thanks, Mike. Thanks for the warm introduction. Certainly, my career in finance has been a lot longer than my career in lecturing so far. So hopefully, I can pull a good flow together here. Thank you all for coming. Also to not just to the SAIS students, also those from the University of Bologna. It's great to be back here. I love my time at SAIS. I remain very, very passionate about the things that I studied and also about the mission of the school. And this evening is an opportunity for me to combine some of the things I learned at SAIS with my professional life into a discussion with you, and I'm grateful for it. I'm also assuming that there are varying degrees of expertise in this big group. So I'll try and find a common denominator. We could go very, very deep on this stuff. It's actually been quite hard to pull this together because some of the topics around financial markets implications of geopolitics and macro developments, it's very, very, very multifaceted. So I'm assuming that not everybody has the same level of understanding or literacy in these topics. They don't really teach the sales and trading piece of investment banking as much in business school as they teach corporate finance and M&A. I don't think there is a real theoretical curriculum around it. You just get stuck on the trading floor in an internship or whatever it might be, and then you learn what you can, and you don't really get to see it in the MBA curriculum. So some of this is potentially also slightly uncharted territory. If it's not deep enough for some, let's go deeper at cocktails. And if it's too technical for others, we can also clarify in the Q&A. And again, all of these topics, sales and trading, technical analysis, market dynamics, what you mentioned, Mike, why markets don't always react the way theory dictates, could have a lecture of their own. So let's try and condense this as best I can into 30 minutes. What I thought about covering were the following. First, the major themes, or one major theme that I think is pretty much driving everything in financial markets at the moment. There are really three major themes, but I think one of them stands out. I'll come to that in a second. Then secondly, an attempt at theory, how markets are supposed to react to these themes. Then in a third section, why it often happens differently, maybe why it always happens differently. If we have time, we'll go through some real world context in terms of how market participants navigate these dynamics, particularly banks. I spent most of my career with banks at Morgan Stanley. Banks as asset liability managers were my clients at BCG. The leadership of global banks were also my clients in terms of how they wanted to readjust their strategy, particularly in response to their business mix, how overweight or under that weight they might have been in the financial markets businesses. So if we get to the real world context, I'll do a deeper dive on banks with potentially some anecdotes as well. Also important, what does this all mean? What's next? What could developments actually mean for the next 6 to 12 months? Again, topics that we could have covered, but I don't think we'll have time for things like Europe-US divergence in the markets. The AI theme, are we in a boom or a bubble phase right now? And what does that potentially mean for the global economy and financial markets? And I think what probably might be of great interest to you, and again, perhaps this is something for the Q&A, what does the development of AI in terms of financial market implications mean for employers? What does it mean for their talent strategy? What does it mean for navigating financial markets, and to what extent opportunities are coming and going for people looking to enter that job market? So On that note, let's move to the themes. I think there are three major themes, of which the first one is the one we'll focus on because I think it drives everything. Theme number one is America First, the America First agenda. Theme number two, I mentioned it already, is the AI boom bubble and concerns about another dot-com style crash. We'll cover that if we have time, if we probably won't. The third is what I would call a period of heightened geopolitical sensitivity for the markets. I think the last 5 years have been inherently much more unstable than the preceding 20. And when we think about themes, let's take the America First piece. It starts with a philosophy, some level that's the MAGA philosophy. Philosophy, if one gets into office, then becomes policy. Policy drives economic thinking and economic execution. And then finally, all of that evolves into some form of market, financial markets impact and context. What are markets? Markets are the collection of different asset types, from stocks, which are publicly traded companies on exchanges, bonds, corporate bonds, government bonds, so debt financing, of which the government and the public sector is the largest component, currencies, foreign exchange, commodities and precious metals, real estate, and then alternative assets, from which I would also include digital assets. That's on some level the universe of the financial markets. These are the public markets, right? What you would learn in business school is very much the private markets, corporate finance, how banks raise funding and capital, and how they manage their assets and liabilities. So in terms of America First, what does that mean? What is the philosophy? You'll know this just as well as I do, but sort of the financial markets take on this is that it's Trump protectionism. Trump is looking for the deal. The US, from his perspective, has financed the security blanket for the rest of the world for a long time. Also provided a huge amount of economic assistance to democracies worldwide. And from Trump's perspective, the US hasn't monetized that, hasn't been paid for it. And when you think about the deal, there's got to be some way to get paid for that security blanket, and that's tariffs. It's tariffs, trade wars. Two, it's deglobalization. So defunding of alliances, exiting the WHO, exiting the Paris Accords, downsizing commitments to NATO, being critical of the UN. Three, it's internal navel gazing around North America. So being critical with Mexico and Canada, thinking hard about drug economies in South America, nonsensical rhetoric around the national security importance of Greenland and the Panama Canal, relabeling geographies like the Gulf of Mexico into the Gulf of America. Four, in terms of the American First ideology and philosophy, it's seeing artificial intelligence as the driver of American dominance. And that means controlling those supply chains and getting better and more reasonable access to rare earth resources. So Trump cares a lot about China in that context, much less about Europe. I mean, what Europeans don't quite appreciate, or maybe are starting to appreciate, is the degree to which they've become less relevant in the MAGA and the American First agenda. And then finally, it's fiscal expansion. So you talked about that, Mike, giving $2,000 back to everybody. It's the politicization of fiscal and monetary expansion. It's the politicization of the Federal Reserve Bank, Central Bank of the US, to do MAGA's bidding. And it is perpetuating tax cuts and the funding of them for growth in America. It's also recarbonization on some level. So that's the philosophy. And how does it translate into economic policy before we get to markets? So the first one, the tariffs, it's essentially full-blown trade war on some level. And that leads, Mike, correct me if I'm wrong, but in most cases that should lead to some form of stagflation. Supply chains start breaking down globally. Look at the auto industry in Germany that's essentially on its knees as a result. Companies cannot immediately pass on, mainly it's very apolitical or very anti-political, can't simply pass on the cost to consumers. certainly not in the beginning. So margins drop, corporate profits drop, and certain sectors come under pressure, especially in supply chain heavy areas. Again, it's lower taxes for longer, financed by debt, which means there are implications for the government bond markets because somebody's got to buy that debt. It doesn't come from nothing. And then there's also other countries having to step up, which puts pressure on their finances, potentially, specifically their fiscal positions. You see it in the EU, particularly in Germany, record borrowing. It remains to be seen whether that borrowing is actually going to achieve some kind of return. We'll talk about that in a second. And Europe has been much slower, and it's also the immigration piece. Right? This puts great strain on the social security systems. Solving that is not an easy one, as probably one of the biggest challenges facing a lot of the public sector globally right now. But the economic implications are that the social security systems tend to be overburdened, which also have implications for bond markets and potentially also for growth. So that's the economics. When we think about the market implications, so how does it affect asset prices? What would we expect? Whether this happens or not is something we'll take a look at in a minute. So you would expect stock markets to fall with this type of policy. Global network types of industries that rely on international supply chains and resources from abroad and flexibility of labor between regions, they will struggle. You see struggle in the consumer sector, companies like Nestle, like Nike, like Adidas, autos I mentioned before. Inputs become scarcer and more expensive, can't always pass it on to consumers. The value of a stock, what is a stock price? Stock price actually is defined as the present value discounted back to the day of all future earnings. So if your expectation is that earnings will go down because margins are going down, then the stock price will fall. That's what should happen. So stock markets should, on balance, fall. Of course, between different sectors, it will have a different impact. That's the first thing. And secondly, some sectors will benefit and some will lose big. I mentioned the ones that will lose big, and that's actually been playing out over the last 6 to 12 months. But other sectors will benefit. So big tech, also medium tech benefit because of again, America will lead through AI dominance in the world. So a lot of public and private funding is going into these sectors. And there's a real belief that there will be a massive return on that investment. That's why you see valuations in some areas of the tech market that essentially are unthinkable. Are they crazy? Well, they're there, right? The market essentially is usually right. They're there. And certainly, perhaps you know this quote, markets can remain irrational far longer than you can remain solvent, right? Maynard Keynes, probably one of the wisest quotes ever. Right? If you'd have shorted, or if you'd have sold short some of these stocks like Palantir or Nvidia over the last 2 or 3 years, you'd probably be having a major financial problem now. Steeper yield curves. Let's talk about the bond market now for a second. So again, growth, tax cuts, MAGA agenda, ultimately financed by debt. Now the central bank, so you have a yield curve of short rates to long rates. Let's take the government bond market. So the shorter end of the market, meaning 1 and 2 year bonds, tend to be very, very strongly correlated with central bank policy. So if the Federal Reserve Bank lowers rates, it usually has a disproportionate effect on the shorter end of the bond market. The longer end of the bond market, 10 to 30 years, or 5, 7, 10, 30 years, is much more of a function of macroeconomic realities, inflation in particular, fiscal policy, all of these. So if you need to have a proper financing program in 7, 10, and 30 years, you've got to find investors to buy that debt. So if you're expanding and you're needing to finance that expansion with ever more debt, the price of that debt has to go down, or the yield has to go up for you to find investors that are willing to invest into that debt. So you would expect a steeper yield curve when you have large inflationary fiscal expansion policies. 10-year yields, 30-year yields would tend to rise disproportionately more than 6-month, 1-year, 2-year yields. You would see US dollar weakness. There's a number of theoretical reasons why you'd see that. As America looks inward, and as Trump tries to politicize the independent central bank, you could see a withdrawal of faith in the US system. We have seen that, which would affect the value of the US dollar. America doesn't care about the world anymore. It's not entirely true. America cares about the world in a commercial sense in terms of what the return can be on investing in the world. But that's a vast departure from the paradigm that existed before that. So you would expect US dollar weakness. In absolute and relative terms, you would see appreciation of what we call safe haven markets. This also has a lot to do with geopolitical sensitivity. So what's a safe haven market? It's something that's perceived to be outside of the system. Gold is a great example of that. The Swiss franc is a great example of that. Independent country doesn't tend to get involved in other people's businesses. Maybe Bitcoin is a good example of something that's outside of the system. There's also a scarcity piece. It's a finite asset that plays into the what I would call the phenomenon of Bitcoin appreciation. But these types of assets, in times of geopolitical instability, and certainly in times where the world's reserve currency or the world's reserve economy starts looking more inward and less outward, you would expect them to appreciate. And maybe just a final word on relativity. And this is one that I've kind of got wrong this year. I look at Europe and I think, well, all these things that we talk about in America, the fiscal deficit, let's call it the almost incompetence and incoherence of messaging and all these types of things. I think they're far more pronounced in Europe, frankly. I mean, Germany's raised $1 trillion. The EU is looking for another 800 billion. I mean, Germany's broken the debt barrier that is formed into the constitution. I mean, there is no symbol of poorer fiscal discipline than that, in my opinion. So my sense was always everything is true in America is actually even more true in Europe. So I would have expected the euro to depreciate to the US dollar. It hasn't. Come to the next point in a minute, why things don't actually happen the way you would expect. In the second half of the year, it has been. The first half of the year, it definitely didn't. The DAX index, I have a chart on this that I can look into later, outperformed the US stock market index by a good 10% in the first half of the year. So all of the things that I think are affecting America, its influence in the world, I think actually are also present in Europe. So on a relative basis, I would have thought that Europe in general would underperform. And for the most part in 2025, it hasn't. So that's essentially the theory. Now that so just to summarize that quickly, we'd expect one, stock markets, so America first, right? That's the philosophy, that's the economic policy, budget deficits, big, beautiful bill, tariffs, etc. You would expect stocks to generally sell off. You would expect defense, tech to outperform. You would expect industrials and consumer sectors to underperform. You expect you would expect global yield curves, or the developed global yield curves, to steepen given fiscal expansion and monetary discipline. You would expect interest rates generally to slightly go up because you need to finance that debt and find buyers for it. You would expect safe haven assets like gold, Swiss franc, maybe Bitcoin, to appreciate. So what's actually happened? Let's try and see if I can pull up a couple of slides now. And I look at this very much from the perspective of somebody that actually lived through a number of crises. So throughout my career, I saw the bond market crash of 1994. I saw the hedge fund crisis, long-term capital management of 1998. Lived through the dot-com boom and bust of 2000. The worst of all was the global financial crisis of 2008, and then the euro crisis of 2012 on, let's call it a rather diminished scale. But lived through all of those. So it's easier to put things in perspective when you've seen all of those types of crises rather than the benefit of 3 or 4 years of hindsight, which frankly, a lot of people can't help it. I mean, it's a generational thing. I think most people that manage money these days in their 30s or late 30s, they haven't seen real bear markets and they haven't seen real crashes. So be careful whom you trust your money onto. If you're just starting out, the last 5 or 10 years are not indicative of what the previous 10 to 30 were. So let's see if I can.
This one.
Yeah. There we go. So this is not the one I want. I'll come back to that. So here's the main stock market in the US that people follow is what's called the Standard & Poor's 500. 500 largest stocks trade on the New York Stock Exchange. And that's been a pretty nice story, I would say. Can I get rid of this somehow? So I can not see that. Yeah, there we go, that's better. That's been a pretty nice story since essentially 2022, when I think this was probably somewhere around the Russian invasion of Ukraine. It's been almost a continuous rise up, a good 30–40% here. And if we take a look at 2025, this is April, I think.
Looking at the Swiss franc right
Let me
now.
just move this. Maybe I can I change this here? Am I looking? Yeah, I just
This is
moved
a Swiss franc currency index.
it. Yeah, 1 sec. There we go. I tried to get rid of this thing here so you could actually see the years. Thanks, Linda. So it's been a fairly good story, I think, since 2022 here. This is 2025, and this was the so-called Liberation Day. Right? This is blew me out again.
Should I just leave it?
I think it's okay. Don't worry about it. No, this is perfect.
Is that perfect?
Yeah.
Okay.
Thanks. Thanks, Linda. So what actually happened here? So you would, like I said, you would expect a sell-off. You would expect the market to do exactly what it did here on Liberation Day. Right? It sold off a good 20%. Again, this is the US stock market. The same was true for most major indices across the world. What I think was not expected is this absolutely almost immediate bounce back. I think most people would have thought, okay, this is the beginning of some form of deterioration in the stock market. This Trump thing is real, it's permanent, which means we have to adjust on a more consistent and permanent basis. Basically, the market blew it off, right? Down 15%, 3 or 4 weeks later, it's back where it started. Some of it was because Trump flip-flopped and said, okay, yeah, I'm not quite as serious about this. We're going to put it on hold for 90 days and then we'll see, etc. And everybody got themselves out of the market and scrambled to get back in again. But this essentially is what happened here. So that was the stock market. No, I'm just going to find the right thing here. This is the German index, the DAX. The DAX is top 30 stocks in Germany versus US S&P. At the beginning, I think this is the beginning of 2025. You can see that the German market vastly outperformed the US market. And this is as capital flows started to lose a bit of faith in the US. Well, where else are we going to put our capital? We need a big economy to put it into. It can't be some emerging market index. We have to take our reserve currencies. We've got billions and billions and potentially even trillions of them, and we've got to put them into something substantial. The euro tends to be the beneficiary of these types of dynamics. But in the second half of the year, the US started retracing all of this underperformance versus Europe, probably more along the lines of people waking up to the fact that Europe ain't that great either, for the reasons that we mentioned before. So then I wanted to look at tech. Here's a Swiss franc. I mean, the Swiss franc has been a reasonably good story. If you look at an index of 100 in 2023, it's now trading at 125. So the Swiss franc, over these periods of what I would call geopolitical sensitivities and the global setup is somewhat vulnerable, the Swiss franc always tends to do well, and that bears it out. That one again. This is important. I'm going to come back to this. I just wanted to show gold. Crazy. I mean, gold is insane, right? This is essentially, since 2024, we've gone from $2,500 an ounce to approaching $4,500 an ounce. That's probably in silver and other precious metals have actually been more extreme. But gold is sort of that is the bellwether benchmark. So that would be as expected. That's the yield curve in the US. So this is the 10-year yield minus the 1-year yield. And you can see that's essentially been steepening. So the difference between 10-year yields and 1-year yields has essentially been growing, as you would expect. I mean, it's had some setbacks, but in general, that's been a rising market, which, again, a rising yield curve is usually a function of two things. One, strong, aggressive monetary policy, easing policy. It's kind of the case, but not really. And two, persistent inflation. And then overarching all of that, what I would call aggressive fiscal expansion. You would tend to see steeper yield curves, and that's what's happening. Here's Bitcoin. Bitcoin's a bit of a mixed bag. I think it's not as I think Bitcoin is not accessible, or let's put it this way: the unregulated nature of this market and the use cases for it have made it somewhat remote for big traditional asset managers, not niche or hedge funds and other market participants, but not everybody's participating in Bitcoin. So we can't. So the jury is still out on whether or not this is something outside of the system that could represent some kind of safe haven. But there is a scarcity factor. I mean, over the past 5 years, 533% increase. Bitcoin is finite. Only a finite amount of coins can be mined. With that in the back of people's minds, there's always a scarcity factor that keeps the price potentially artificially high. The tech sector, this is very interesting. Come back to this in a minute. So the next theme is market technicals. Why things don't always pan out as one might expect. Remember, I mentioned that quote, market can remain irrational longer than you can remain solvent. I don't know how many of you are familiar with what's called technical analysis. Some of you will definitely be. It's very hard to invest or to be in any kind of investment management without some understanding of the fundamentals of that today. Looking for my notes here. Technical analysis essentially is the study of price dynamics and momentum. So who is positioned how and where are the big flows happening? If everybody owns an asset, there is no fundamental news in the world that will make the price of that asset go up because everybody already owns it. If somebody buys something at 100, it goes to 110, and that person doesn't sell it, and then it goes back below 100, pain begins. So these types of local crucial areas where many people come into the market or many market participants come in at once tend to be trigger points where if they're penetrated, you generally see what I would call excessive reactions. And just going back to our S&P discussion, this is what we call, I just must, yeah. So in April 2025, when we had Liberation Day, the S&P dropped below 5,000, and active asset managers moved heavily out of the market. Right, so this is the S&P here. This is this big drop, 15-20% drop that we saw after Liberation Day. Trump flip-flopped. There's all sorts of shenanigans going on there. I'm not quite sure. He said, yeah, you should be buying the market, and your fault if you kind of missed it. There is some element of market manipulation potentially in that behavior. Anyway, at this point here, what this red line is showing you is that 35% of the market was fully in, just 1 second, I'm really apologize. My notes are yeah. Just apologies, I have to get myself straight here. Did I say the right thing? Yeah, what this is showing you, we saw it here already, is that the market was getting very, very long, very, very over-invested. When this pullback happened, there were a huge amount of forced sellers. And I don't know how many of you in your circle of acquaintances heard people say like, oh my God, if this market ever corrects, I'm in, or we're just waiting for this pullback. Something, if we see a 10% correction, we're immediately in the market. I mean, from my circle of friends and also institutional investors, when we were up here, and I'm saying the market was 35% bearish up here, meaning it was reasonably underinvested. The market then started to come down, and all these players that were underinvested saw an opportunity to get in, which explains a lot of this pullback here. Today, we're actually only at 13.5% bearish, and that's the highest level I think we've seen in something like 15 years. Sorry, the lowest level of bears in the market we've seen in something like 15 years. So the market currently is hugely, hugely invested. The last time we even approached something like that, we saw a 15% correction in the market. So there is some very, very strong case for, this to correct on some level over the next months. In terms of the tech bubble, this is Palantir, which is a provider of a number of different platforms for artificial intelligence data solutions. Palantir, at the beginning of last week or the week before, was trading at 243 times future earnings. For a company that's almost 500 billion market capitalization, puts it in the top 50 companies worldwide, that's never been seen before. Anything above 100 is actually unheard of. So the question is, when it comes to some of these medium to larger size AI providers, is the market overextended? Because essentially what it's saying here is that they would have to earn 24,000% over time what they're earning today. Possible? Don't know. Probably not. These kind of valuations are unheard of. NVIDIA is now a $5 trillion company. 15 years ago, it had a market capitalization of 15 billion. It's now a $5 trillion company. NVIDIA, Microsoft, and Apple are 22% of the S&P 500. That's also the highest concentration of 3 stocks in any major stock market index that's ever been seen. So from a theoretical, fundamental point of view, a lot of these indicators are saying, sell. Valuations don't make sense. The market is oversaturated. Investors are too bullish, etc. Yet, we haven't seen the crash. We haven't seen the drop yet. My sense is we probably will see more corrections over the next 6 to 12 months in the stock markets than we've seen in the preceding 2 or 3 years, save, of course, April 25 and Liberation Day and external shocks like that. But I'm skeptical that we're going to see a major crash. If you think about market participants, it's true. I think on the institutional side, asset managers, hedge funds, insurance companies, sovereign wealth funds, which is incorporated in that chart that I showed you before, I think there are very few bears. Most are fully invested. Most are very, very confident about things going forward. When it comes to other market participants like retail, like public sector, if you think about Germany, for example, a lot of the German population is not invested in the stock market. Pension funds don't tend to touch it. Insurance companies that manage private pensions have stayed away from stock markets largely. It's coming. But there is a huge, particularly in Europe, there is a huge stock market underinvested part of the economy that I think is still waiting and still able to absorb what I would call larger market sell-offs. like we saw in April, that would then turn things around pretty quickly. So my sense is more that we're going to see smaller corrections, but more frequent over the next 6 to 12 months than we are one big crash. Maybe I'll stop there for a sec, Mike. I have so many more things to do. I mean, the other things that I thought about talking about were market participants, particularly banks. And again, the implications of AI for corporate strategy, particularly in the bank sector and things like that. But maybe I just stop there and we'll take it for questions.
Well, there certainly is a lot on the table. So why don't we open it up to questions? A few things because of the infrastructure we have in the room. When you ask the question, if you could come to the front of the room and ask your question so people online can hear you, that would be great. So if I could just start it off and abuse my role as the chair. You didn't talk much about the role of private equity these days. How is that fitting into this market picture that you're painting?
Well, I think it's private credit, private debt, and private equity. I mean, the big development now is that the real economy is not just financed by banks anymore. It's financed by private companies, the private equity companies that traditionally have started up and provided financing for non-public companies. We're seeing a lot of financing now in the traditional domain of the banks by the private equity companies and other participants. That's a private debt phenomenon. I worry about this for a number of different reasons. First of all, we call this the shadow banking system. Global financial crisis, and this is the work that I did at Morgan Stanley. Banks are completely overextending themselves into risky assets, particularly things like structured credit or the whole subprime piece, etc. Those loans didn't just go away, they just depreciated and became distressed. And then the banks had to offload them to comply with a stricter regulatory environment, and they generally tended to be bought by these types of alternative asset managers, hedge funds, private equity. They would buy a lot of the bad loan portfolios that the banks had accumulated over years into the crisis. So that's point one. They accumulated a huge amount of we call them the shadow banking system, because they essentially took on the debt profiles of the banks that, for regulatory reasons and also for shareholder reasons, couldn't afford to do it anymore. Step two now is that there is a whole new debt. So these were existing loans that just became distressed and then were bought by the shadow banking system. Now the shadow banking system is originating loans outside of the banking system. So that's sort of a step two in this whole piece. And it's a very, very big business, right? Companies that probably would take a long time to get some form of financing from a bank at a certain level can work with a private company and get reasonably rational financing, right, outside of the banking system. And that whole shadow banking system, which is trillions and trillions and essentially fairly risky, is not super regulated. Right? Banks are very heavily regulated. You could argue, with a couple of exceptions like Silicon Valley Bank and others, that it's tough to conceive of banks running into massive trouble compared to how it was 10, 15 years ago. But these companies are very, very smart, right? But they have the risk. They have the risk that the banks would traditionally have, right? I think private equity is a separate discussion. That's a reasonably mature and an established industry, but private debt is not. That's fairly new, it's fairly extended, and it's fairly unregulated. So if you think about a shadow banking system that is emerging, that is not hugely regulated or monitored, that for me is something that's percolating in the background that worries me.
So the risks are still there. It's just it's being channeled into a financial sector which is less regulated. And
Although I would argue on some level these are very, very smart people at these firms. They get paid huge amounts of money because they are very, very good risk managers. But if you think of things from a portfolio context, I mean, banks for years and years and years have been running their credit portfolios in a very, very organized fashion. There's a theory to it about how you manage your tall trees, how you find exits for, let's say, overexposures, how you keep your, let's say, your loan portfolio under some kind of discipline, whereas a hedge fund manager or somebody who's paid against performance might think more idiosyncratically around individual loans rather than a whole portfolio. So on a number of different levels, it worries me, and I think it worries a lot of people. How do you get on top of it? I think ultimately the sector probably will see heavier regulation. I certainly, from consulting, I can tell you that around 2016, 17, when I actually left Morgan Stanley and I started thinking about what am I going to do next, there was some interest from alternative asset managers to speak to me about how to actually set up proper corporate structures. I mean, if you think about a traditional hedge fund, it was a managing partner who was interested in managing money and speaking to his investors or her investors. Once they've taken on huge amounts of systemic risk as shadow banks, and the fear comes that, oh God, at some point we're going to get regulated, these managers start thinking about how to really build proper corporate structures with compliance officers and chief operating officers and people that actually manage the firm and the organization rather than just the money and the investors. And so I think it's coming, and I think these firms that do manage private debt and certainly private equity, but also hedge funds, are much more structured, much more disciplined in their corporate structures now than they were 10 years ago. But it's probably that's not gonna turn back. That's probably gonna get even more acute.
Okay, thanks. Okay, so why don't we open it up to questions, and if anyone online has a question, please send us a note. But let's go. Please. Could you come up? Could you also say your name and where you're from?
Yes, my name is Ariana Rue. I'm from South Carolina in the United States, and I am a student at SAIS. My question is, do you mind expanding more on why you believe that there will be more smaller corrections over the next 9 to 12 months versus a big crash, especially with the high valuations that we talked about earlier?
Yeah. I mean, I can't exclude a crash because something crazy can always happen, but I think it's market psychology. I think there is still a very large, despite the fact that institutional investors now are generally, let's call it invested to over-invested, I still think there is a large group of market participants that would still be happy for the market to correct so that they can buy it. I still think there is this cushion that exists in many major markets that will provide some kind of base to prevent the market from really crashing out. I mean, that's point one. Point two is diminishing returns of what I would call news shocks. So we saw the market dip when Russia invaded Ukraine, but every piece of news after that had a diminishing effect on the market. The same was true when Iran strikes with October the 7th. At some point, the market gets very smart at decoupling, let's call it external global idiosyncratic events from, let's call it financial reality. Corporate profits are still extremely healthy in most sectors. The tech industry is not the entire industry. Again, in the S&P 500, it's three companies control 22.5% of the S&P 500, and those three companies have hundreds of billions of free cash flow. And the other 70% people are not over-invested in. So, and then I go back to my point that flows are there to be taken advantage of. So small market corrections, I think, will be picked up pretty quickly. And I think the final piece is, the other thing that Warren Buffett said was never bet against America, right? Never bet against the US economy, which is why when you see the DAX outperform or the German index outperform the US S&P by 15-20%, you should probably take the other side of that bet, which would have paid off in the second half of this year. But again, I think longer term, there's not a huge amount that suggests to me that the economic fundamentals are extremely weak. Corporate profits, again, very, very strong. Most sectors outside of big tech and defense, probably not overinvested in. And those that are overinvested in, the tech sector, have pretty strong cash flow. Now, there are some companies, of course. I mean, another one was Silicon Valley Bank that collapsed in the last couple of years. It was a blip for a couple of days. One could have said, okay, this is a serious asset liability management issue. And does this, because the mid-cap banking sector in the regional banking sector in the US is not as heavily regulated as the globally significant institutions, does this mean that they're all vulnerable? Okay, people panicked for about a week and then it was over. And I see a lot of that right now. A lot of, I don't call it complacency, I call it more rational economic reality, right? Rather than emotional knee-jerk stuff, which we saw in April. People aren't going to let April happen again, right? So a market correction is to be taken advantage of. But that being said, again, 13.5% bear does mean that we're probably reaching a point where a huge amount of upside is not possible. But I don't, my personal view, again, is just a disclaimer to, these are my personal views, and I don't represent any company other than my own interests in saying that.
Okay, good. Just back.
Hi, my name is Sagar. I'm a first year student at SAIS. My question is, historically, gold and stock markets have been negatively correlated. And with the current rally in commodities, do you think smart money is moving their funds from stock markets to gold and discounting for what's going to happen in the future? And second, as you mentioned, US has very little fiscal space in terms of expansion as compared to the EU zone or Germany. So do you still think investors will benefit shifting their money from US to Europe?
Take the second one first. No, I don't. In fact, that's my entire point. I've been wrong though. I think on a relative basis, Europe is even less healthy fiscally, and certainly less healthy entrepreneurially. I think the bureaucracy of European institutions is very difficult, for example, to develop an innovative, forward-thinking AI industry or to attract capital from other countries. Why would you go to a place where you're heavily taxed, heavily regulated, where the rules are very, very suffocating, and where traditionally there's been, it's been old economy, right? So I've not been a big believer in this idea that there'll be a permanent flight out of the US, certainly into Europe. So that's the second part of your question. On the gold piece, where else, gold is the ultimate safe haven. I think as things get frothy and people start to worry a little bit about diversification and is there much juice left in this market or is there much less juice in that market? And is inflation still a problem with tariffs and central bank accommodation, et cetera, gold is a very, very obvious choice. It's always been the historical choice as an inflation hedge, as let's call it a geopolitical risk hedge, whether it's physical or whether you invest in mines or you're looking at some form of derivative exposure. It's been borne out, right? It's been borne out this year in a very, very big way. Does that answer it all?
Yeah, kind of, but I was thinking if investors are looking forward to something major shock in the future.
Yeah, I think there is, I think when gold is up, what is it? We look in 2023, we're at 2,000, we're now at 4,500, so you're up. Yeah, I think when the gold price does that, there's definitely some psychology there that's saying we're worried about something. Absolutely. Or either we're worried about something, or it's the most obvious place for us to park capital. We want to be invested in something. We don't want it sitting in cash. The stock market looks frothy. Bonds we don't like because of inflation. What's going to give us a good amount of return that actually is traditionally stable, safe? It's gold.
Hi, my name is Max Donkel. I'm a junior at Dickinson. Just want to say thank you very much for your time today. My question is regarding the AI bubble. You touched upon it briefly, but there's been a lot of comparisons with the dot-com bubble, like you said. And I guess it's probably the million-dollar question, but what companies do you think will withstand a bubble if it does pop? In the dot-com bubble, we had Amazon and Meta. And then the second part on that question is the focus on the U.S. firms overweight? Do you think we should be maybe looking at China per se?
I think for the first part, my personal view is we're still in a boom phase. We're not yet in a bubble phase. I still think the proportion of funding and leverage that goes into these companies is not yet systemic like it was in 2000, or like it was in subprime in 2007, 2008. It's still relatively concentrated. I think the big companies that have humongous amounts of free cash flow are in reasonably strong shape to withstand a crash. What I do worry about is the circularity of that industry. And what do I mean by that? I mean that some of the smaller companies actually can't fund expansion until they get bought by some, or until larger companies take stake in them, and then these smaller companies then buy the chips and the resources from these larger companies. It's very, very circular. At some point that gets popped as well. We've seen that in many financial crises. So I think there is some inherent instability there, the interdependence between big tech and little tech, let's call it. But I don't see, I've been reading a lot of research on this recently. I don't see some of the elements, despite some of the valuations like we saw with Palantir and others, that would suggest that there is a fundamental, let's call it almost criminal instability in this leverage, right? Like subprime was borrowing against borrowing, essentially against assets that that either had no value or weren't even existing. There's none of that, or little of that I can see from afar at this point. So from that perspective, I don't see that. I don't see that in the same light. And similar in .com, where I think the substance, these companies were not earning, they were not making a return, there was no profits, there was no real cash flow. That's not true in this environment for many of these companies. There are actually business models that do actually provide stable profits. But the vulnerable companies are the smaller ones that can't essentially fund themselves. Their exit is usually to get gobbled up by somebody larger. Yeah.
Interesting. Okay, we'll go here and then when you come next. Please come up.
Nice to meet you, Mark. I'm a student of quantum finance in Bologna. My question is, do you think that now... Can you speak a little louder? Yeah, sure. Do you think, in your opinion, that now or in 10 years there could be a bubble about the loan of the private equity enterprise?
Not so much private equity, maybe private debt. Private debt. I think the private equity industry is reasonably well established now. I think what companies are struggling a little bit with in private equity is exit. They have a lot of cash. They've accumulated a lot of cash over the last 3 or 4 years. Bought a lot of companies in the early phase, et cetera, et cetera. It's not so easy to IPO those as it was maybe 2 or 3 years ago. So I'm a private equity investor. I'm finding that the time from investment to actually getting distributions out of these private equity funds is typically a couple of years longer than it was 5 to 10 years ago. So inherently, that suggests to me the market is a little bit saturated, but I don't see any bubbles in private equity from that perspective. Private debt we just talked about. That's more problematic in my opinion. That's quite oversaturated. That is again not hugely regulated in terms of which companies are lending to which firms are lending to which companies. Without covenants, without financials, without real contractual rigidity in the transactions. That for me is a little bit more problematic. There's quite a lot of literature emerging right now. Are we in a private debt bubble? Is that market now oversaturated? Does it provide a risk for the rest of the economy? I think combine that with the accumulation of bad assets in the post-financial crisis, and I think you do have, let's say, sort of an accumulated risk base that needs to be regulated more heavily, and probably will be. So I see more risk in private debt than I do in private equity of some form of market disruption.
Thank you for coming today. My name is Nico. I'm also a SAIS student. I'm from Germany, and my question is also about the German borrowing, since you mentioned it. I think financial markets were kind of okay with it when it was announced that they would borrow this 1 trillion, and now the news have come out that only 50 cents of every euro that goes into the spending package is actually going towards defense and infrastructure. What do you think that will do to German bonds and their
It has already.
status?
I mean, bonds in the last 12 months have gone from 10-year bonds have gone from a yield of 2.1% to 2.75%. Right? So we've already seen a significant uptick in 10-year yields in Germany. It's incredibly problematic if there is no discipline around the spending. If a government goes into debt, the expectation of the electorate is that that debt has some kind of return. And if money is going to Ukraine, if money is going into, let's say, plugging holes in local and communal political organizations and propping up the social security system rather than fixing the roads, mending the bridges, making sure the trains run on time, right? A big German bugbear at the moment. Then you have an issue. Then economically, there's no return coming back on that, let's call it that fiscal investment. And that's going to have implications for stock markets, it's going to have implications for debt markets, and it's going to have implications for political stability. So, I think Germany is a very, very problematic, is in a very problematic situation at the moment. And without clear leadership to be able to set down some real guidelines, the coalition politics are a disaster, right? The CDU has essentially very little in common with its coalition partner. It's incredibly hard to get things done. But
I am Bart Drakulich, SAIS class of 2005. So it seems like there's sort of two competing narratives. One that's driving an AI increase in the value of AI companies, people that believe that AI is going to radically transform our economy and the lives, and that this isn't just a bubble, that there actually may be something to it. And then sort of everybody else that is looking for shelter in gold or Bitcoin and things like that. But overarching all of this, you've had, and we're running out of terms for it, bazooka money, helicopter money. You've had the loosest fiscal policy for decades in the United States and around the world. Governments are taking on more debt. You talk about companies awash in cash. And it sounds like this might be a question for Plummer, a basic macroeconomic question. You have too much money chasing too few goods, which is causing all kinds of different assets to increase at the same time. So my question is, for whoever wants to answer it, is interest rates have gone up a bit, and the government has tried to absorb some of that money, but was that enough? And what would have to happen for there to be a correction in the amount of money that's circulating in the system that would then affect these markets?
I'll give you a chance to speak in
Yeah,
idea.
no, go ahead. I've got my own views on this.
there's so many variables, right? There's money supply, there's creation of money. I mean, we'd probably be happy that quantitative easing has stopped to a certain extent, but I think I didn't talk about this, but there is a very, very big element of money still sloshing around from zero interest rates over the last 10, 15 years, right?
And the pandemic.
And the pandemic, yeah. Where people saved more and essentially had more money to invest. I think it's a very, very big piece is that loose monetary policy over the last 10, 15 years has created this sort of, let's call it, almost a permanent call option on the market, right? Because anytime it goes down, there's still money willing to absorb that sell-off. And I think everything that we've talked about this evening is encompassed in that phenomenon. So what does it take for all that money to kind of equalize out? Well, I would have thought, to be honest, that we would have seen some of that when we had inflation rates of 7-8% plus, and the Federal Reserve Bank and the European Central Bank and pretty much every major government in the world started tightening. I thought we would see some form of correction, some form of, let's say, self-protection in terms of how you invest. And frankly, it didn't happen. I can't actually answer your question, Bob, because it perplexes me too. How much of that loose monetary policy is still not fully absorbed by relatively higher interest rates, by being fully invested, etc. My sense is from the price action that we see in most of these markets, this is still quite a way to go, right? Because gold doing what it's doing, the S&P, how it rebounded in April, corrections not really being very permanent. It suggests to me that there's still plenty of stuff there to be soaked up every time something happens. But when that stops and how far we have to go, and again, we divorce, let's call it, economic fundamentals like Palantir at 240 times price earnings from actually what's happening in the market. What's happening in the market is that there still seems to be a fair amount of liquidity to go places. What do you think, Mike?
Yeah, I think we've got this real issue on fiscal policy in the U.S., right? Which we don't have any political constituency that seems to want to care about it, but the markets are starting to care about it. You quoted Keynes a few times. I mean, Warren Buffett had a very interesting proposal. He said, I know how to put in some sort of a constraint on fiscal policy in the US. You just say that if the deficit goes above 3% of GDP, then Congress people can't run for office again. Then all of a sudden you'll get people to come on, but without any kind of external constraint, without a Maastricht Treaty, without any of these things, it becomes a problem. Okay, so we've got this fiscal issue. And then all of a sudden we have all of these inklings of the politicization of the Fed, right? The possibility that you've got politics going in the Fed, we want big interest rates cuts. And this raises a fundamental issue that, there are three ways of raising money, right? You can tax, right, for fiscal policy, you can borrow. And if these things become a problem, you just make money worse less, you create money. And so the idea that the debt would be monetized, I think probably has markets a bit nervous. And that's why you're seeing some of these issues where, in the past you didn't see this, where in the spring you'd see interest rates would rise some, and yet the dollar depreciated. And that didn't happen in the past, really. It's so, and you know the technical.
Yeah, I know, but that's exactly right. But to Bart's point, if there's still excess liquidity in the market, right, it's got to go somewhere. So if you start looking around, you say, well, I don't like stock markets because MAGA really means tariffs and inflation and protectionism and all these sorts of things, not good for stocks. I don't like bond markets because fiscal deficits mean higher bond yields and lower prices, etc. I don't like bonds. I don't like Europe because of all the things that we talked about as well, and I don't like the US. So what am I going to do? That's why gold comes in, right? Why these safe haven things, because the money's still got to go somewhere. Bitcoin, gold, Swiss franc, of course, Swiss franc outside of the system. Interest rates in Switzerland have been negative or zero for years. For years, nobody should be in the Swiss franc. There's no return. yet it's appreciated 25% in 2.5 years, right? So there is some of that. I don't have anything better, but I have to go somewhere, right? That I think is driving a lot of this right now.
Real estate.
Yeah, real estate. But again, if mortgage rates, if you have a steeper yield curve, 10-year rates go up, these types of things. Oh, my borrowing costs every time I refinance is going to be 2% higher, etc. Normally, yes, right? Normally, yes. Physical assets, something real. Let me own something that actually has bricks and mortar. It makes me feel good. It's comfort. It's safe. It's actually something real. But if the financing of that is expected to go up and cash flow becomes more difficult, I don't know. So gold again, it's gold again, right? Although gold has no return either, frankly.
That's right. Okay, there's some other hands up. Okay, Deshaun.
Yeah, thank you for the talk. I'm Deshaun, student from SAIS, from France. I've got a question about Bitcoin and cryptocurrencies, because I think there's tons of incentives to kind of look for a de-dollarized financial systems in many aspects. And do you think that given the sort of effects from the Trump winning coalition towards Bitcoin, they've been very vocal about their appreciation of these kind of things as well? I think that they're kind of laying the foundations for a system that would be around cryptocurrencies and US-led at the same time, that would maybe also provide some backbone for what will happen to the dollar in the next coming decades.
I'm not a deep expert on this, I'll say that up front, and I mistrust a lot of the Trump agenda when it comes to cryptocurrency, because I think on some level he's not unconflicted. Right, so we'll talk about monetization of office, right? So I'm very mistrustful of the administration's policy towards pushing cryptocurrencies as a source of value. What I do think, I mean, if you think of the stablecoin market now, I think it's something like 450, 500 billion or something of that nature in market capitalization, of which 90% is the US dollar. So I do think from a digital asset point of view, the pushing of cryptocurrencies has strengthened the US position as, or let's say, has corrected some of the flight from the US as the world's reserve currency back into the US as the world's digital reserve currency, right? So from that perspective, I do think there's been some success in reattracting investors and other market participants to the US dollar. And that's why you also see a big push by the European Union and the European Central Bank to introduce a digital euro by 2029. Is to counteract some of that, let's call it, US excessiveness in the digital markets. But I'm not super deep on some of the mechanics of cryptocurrencies. I'm personally not invested. I don't usually invest in stuff I don't fully understand. But I do. But again, to the stablecoin piece, I think Bitcoin is one thing. It's not a stable coin. Bitcoin and cryptocurrencies, again, I'm very mistrustful of any government policy towards that because I think it's not unconflicted. But when it comes to real fiat, real official peg to the US dollar types of stable coins, I think the policy is a lot more sensible until it starts getting into the private sector where the issuers of these currencies, which tend to be platforms, et cetera, have, let's say, unjust advantages from the position of being issuers of stablecoin cryptocurrency. I don't know if I've answered your question, but I certainly am not the deep expert on the digital currency piece.
Lee Murphy, I'm a student at the University of Bologna from the United Kingdom, as I'm sure you can tell. How much are markets sort of treating this sort of America first, sort of, as you described it, sort of protectionism as sort of the new normal? A lot of, or at least some of the tech bubble is sort of tied to the administration sort of ties in with sort of tech world figures like sort of Peter Thiel, Palantir, one of the companies you mentioned, NVIDIA, sort of try sort of questions about semiconductor supply chains and that kind of thing. How much is that the new normal, and how much do you think, do you consider that sort of that it would, that would survive a change in an American administration? Thank you.
I think the trade war, let's call it, I think tariffs is the new normal, right? I think that's, again, it's the art of the deal. America provides security at a price, and that price is you buy American. And if you don't, then you're going to pay a tax on it. So I think on some level, as long as Trump's in office and as long as the MAGA agenda still holds sway and America first, I think investors, I wouldn't say are comfortable with, but have sort of resigned themselves to the fact that they have to navigate this. So I think from that perspective, yes, it is a form of new normal, and that's why I don't think we see these excessive moves anymore when Trump announces something, some bilateral tariff against any specific nation that's upset him on the day. And can you remind me of the second part of your question? Was it AI?
How much, in particular, as with sort of tech and AI in particular, that the links there with the administration, how much do you think the tech bubble survives a change in potentially the administration as well? Sorry.
Oh.
How much of it is based on sort of the value of the technology itself, and how much of it is sort of?
I think you'd have to look at it. I don't know the answer. I don't know the numbers here, but I think you'd have to look at the degree to which the AI boom is funded by the public sector relative to the private sector. I don't know the numbers. I think it's on some level funded by both, because the AI agenda, again, is a vehicle, is an instrument of American economic dominance in the world. So I assume that that the numbers are significant in terms of promotion by the government and by the public sector. But private sector investment is huge in the US. Right? I mean, the numbers that are being thrown around by Meta, by Microsoft, by Apple, by NVIDIA in terms of the investments they're making to develop the sector within the US and globally, hundreds and hundreds of billions, are enormous, right? So if that dwarfs public sector commitments, then it will outlive the current administration. Any thoughts on that, Mike?
Might be the case, of course. Depends on how long one can stay solvent. No, I think what's interesting about the first part of the question on tariffs is that one of the motivations of what seemed to be many was to sort of balance the U.S. trade balance, right? But the one side of this and it was always talked about trading goods rather than trading goods and services. But the third part of that is financial assets. And so the best way to fix the trade deficit is to have less investment from abroad in the U.S. Or if you will, if you continue to have a lot of money that's coming in from abroad into the U.S., then that is going to exacerbate the trade balance, regardless of what the tariffs are. So it'll be interesting. So if you have a scenario where somehow, and this doesn't seem to come from your talk a bit, but if the U.S. becomes a less attractive place to invest, then you're going to see you could see a change in these things. You could see more of a balanced trade. But as long as the U.S. has, if you will, a strong competitiveness in its assets, it's going to have this trade imbalance. So, yeah.
I'm Italian American or American Italian, and I'm an investor in the US stock market. So I follow it basically day by day. Now, one thing that worries me about what is going on in the US economy and in the stock market, it is the weakness of consumers. If I look at private consumption, which is the main driver of the US economy, I can see that small incomes are running out of money. And small consumers are the strong basis of the economy, because high income consumption is quite volatile. Now, at some point, we are going to a limit of all this because there is simply no money. And private credit, even private credit, is not going up anymore because banks don't lend money to small consumers, to small people. So how do you see this unfolding? We have increase in productivity, substantial increase in productivity. But if you look at the numbers, the benefits of this increasing in productivity go mainly at the moment to profits.
Yep.
The increase in real wages is negligible, it's 0.7% in a year.
Yeah, and that will probably deteriorate even further, given what, in theory, artificial intelligence is supposed to do to jobs, which is a topic we haven't even touched on yet. Look, if the consumer, I mean, the death of the American consumer has been announced, I think, several times over the last decades. And I think in an environment where interest rates are not going up, the ability of the American consumer to continue to finance purchases, etc., is still there, right? The question is, are they spending or not? And you're saying they're not. But I don't know what the measurement is or what the report is, on how transitory that is, or whether or not that's a blip or something really structural. I don't know. But one thing that you do say that is very, very true is that the stock market and the investing environment is very much institutionally driven, much more than it is retail driven. It's also measured and monitored more in terms of what institutional participation is rather than private individuals. And as a result, whether the consumers are 10% more active or less active, it hasn't in the past necessarily had a big effect on the stock market. I think everything changes again when interest rates are high. I think, Bart, I mentioned it before. I don't understand why that. Personally, I don't have all the answers either. When we had the COVID supply chain induced inflation of 2020 through 2023, 24, I thought that was going to be much more serious for the markets, because it has a spillover into everything, right? It means corporations have to fund themselves more expensively. It means private individuals, they have higher charges on their credit cards. It means student loans go up. It means everything is more expensive essentially. But again, they didn't spend as much money on dinners and going out and vacations. So they substituted that online and consumer purchases, et cetera, et cetera. If it's true, and if you have a sustained downturn in consumer activity in the markets, yeah, you will see some of these valuations go down because companies become less profitable. Their margins go down. Their earnings go down. Their expectations of earnings go down. The question is which sector. Then it becomes a sectoral play, right? You probably have, let's say, a market that corrects more frequently, as I mentioned before, potentially once in a while, larger corrections, and you have some sectors that benefit at the expense of others. Some artificially, right? I think I would argue that the defense sector has been an artificial bubble for the last year or two. That's not going to, the defense sector is not one that cares about consumer behavior or not, but retail and industrials buying cars and things like that and real assets, that does care about the consumer.
Some of the forecasting reports I've been reading and everything for next year, in the US anyway, are suggesting you actually could see a big bump in consumer spending because of the tax refunds with the big beautiful bill, that this is going to lead to a fiscal boost. on the part of consumers, at least for next year. Actually has some of them nervous about what effect that's going to have on inflation, actually. So you could see it.
I mean, Americans don't tend to save, right? If they have money, they tend to spend it. So what you're saying on some level is it would be concerning, because that would not be the typical American behavior if they have some boost to their income or what it might be and they wouldn't spend it.
It's a quick one, because look, I've been here for 25 years and I've learned never to stand in the way of a reception. So, quick, no, please.
I don't think.
Or maybe why don't we do it at the reception? You can ask.
It's okay.
Anyway, so thanks so much, Tim, for this really enlightening discussion. I thought it was fascinating, and I think judging by the questions, it picked a lot of people's interest. So why don't we go downstairs and go upstairs for our reception. But before doing that, please join me in giving Tim a big hand.
Yeah.
You're okay.
So Tim, in Germany, the fiscal break has now been no longer valid.
No, they changed